So, what's the smarter move right now? Renting or buying a house? It's a question that feels almost impossible to answer, doesn't it? You've got headlines screaming conflicting advice and a housing market that, let's be honest, a lot of people are calling fundamentally broken. It is so easy to feel stuck or confused or even just paralyzed by the sheer weight of this decision. But what if you could cut through all that noise? Our goal in this explainer is to give you a clear, data-driven framework to make a genuinely smart decision for your situation. We're going to go from confusion to empowerment. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. All right, here's our game plan for today. First up, we're going to dig into the new rules of housing to really get why this market feels so different. Then, we'll move beyond the slogans to completely reframe how we even think about the rent versus buy debate. After that, we get tactical. We're going to calculate your real cost. I'm going to give you the exact tools you need. From there, we'll map out your strategic next move with some advice tailored for you, whether you're renting, buying, or you already own. And finally, we'll look ahead at what to watch in 2026 so you can stay ahead of the curve. Okay, let's kick things off with this idea of a broken economy. It's a phrase you hear thrown around a lot, right? But what does it actually mean for your housing decision? Well, in short, it means the old rules of thumb. The advice your parents or grandparents probably gave you about homeownership, they might not be so reliable anymore. The fundamental mechanics of the market have shifted, and to make a smart decision, we first have to understand this new playing field. This really is the question at the heart of it all, isn't it? Even if you have a great job, a solid income, and you've been saving diligently for years, that finish line, it just seems to keep moving further and further away. I want to tell you, it's not just a feeling. It is a reality that is backed by some pretty hard data. The numbers tell a very specific story about why this is happening. And that story, interestingly enough, doesn't begin with the price of houses, but with the price of money itself. So this number, 3.75%, this is not your mortgage rate. This is the federal funds rate. And it is arguably the most important number in the entire economy. It's the rate at which banks lend to each other overnight, and it's set by the Federal Reserve. Just think of it as the foundational cost of money. When the Fed keeps this rate high to fight inflation, it creates this huge ripple effect. It gets more expensive for your bank to borrow, so naturally they pass that cost right on to you through higher rates for mortgages, car loans, everything. What this means is that even if home prices were to drop 10% tomorrow, your monthly payment might not change much at all, simply because the cost to finance that loan remained stubbornly high. This is the number one driver of the affordability crunch we're all feeling. But here's the thing, the pressure isn't just on the buying side. This chart shows us the consumer price index for shelter, which includes both rent and the cost of owning. And as you can see, even though the rate of increase might be slowing down a bit, the cost of shelter is still climbing month after month. It's still one of the heaviest burdens on the typical household budget. And what's really critical to understand here is that these official government numbers, they often lag what's happening on the ground. They're like a smoothed out average for the whole country. So if your landlord just jacked up your rent by 10%, you're not imagining things. The official data is just slow to catch up to the reality that you're actually living. And that brings us to one of the most significant and honestly underreported new rules of housing. See, the mortgage payment, while huge, is no longer the only major variable you have to worry about. We are seeing a dramatic, and in some cases, a pretty terrifying rise in what I call stealth expenses. These are the costs that never show up on the Zillow listing. We're talking about homeowners association fees, which are becoming more common and are rising sharply as their own costs explode. We're talking about home insurance premiums doubling or even tripling in entire states. And for anyone in a condo, there's this constant looming risk of a sudden 5-figure special assessment for a new roof or facade repair. These are not optional expenses, and they are turning predictable homeownership into a financial minefield. So when you combine those high monthly mortgage payments with this onslaught of new stealth expenses, you get this truly stunning statistic. A recent analysis from LendingTree looked at the simple monthly cash flow of renting versus owning, and they found that renting is now cheaper than owning a typical home in all 100 of the largest U.S. metropolitan areas. Let that sink in for a second. Not in some of them, not in most of them, in all 100. This isn't an opinion. It's just the brutal mathematical reality of the immediate financial pressure that buyers are facing today.
Now, at this point, you might be thinking, hold on a second. I just read a headline from Redfin saying that sellers are cutting prices and that a record number of homes are selling for below the asking price. Buyers are finally getting some power back. And you know what? You would be absolutely correct. Sellers are having to negotiate more than they have in years. So how do we reconcile these two things that seem to completely contradict each other?
This is the central paradox of today's housing market. How can buyers be getting discounts while affordability is simultaneously at historic lows? The answer is simple, and it's unforgiving math. A 3, 4, or even 5% discount off the list price, while it's certainly nice to have, is just a drop in the bucket compared to the massive increase in your total monthly cost. That's what's being driven by the high interest rates and those soaring stealth expenses. The discount might save you $20,000 on the purchase price, but the higher carrying costs can easily add up to $50,000 or $60,000 more over just a few years. So the negotiating leverage helps, sure, but it's like using a bucket to bail out a boat that's taking on water from a fire hose. It's just not enough to fix the underlying problem.
And this complex new reality brings us to our second section. See, to navigate this market, we have to move beyond the emotional and frankly outdated slogans that have dominated this conversation for generations. You've heard them all. Renting is just throwing money away. Or on the flip side, homeownership is the American dream. In today's market, these black and white statements aren't just unhelpful, they are financially dangerous. This is the crucial point right here. We have got to reframe the entire question. This is not a moral failing or some personal milestone you have to hit. It is a cold, hard financial calculation. I want you to start thinking of yourself as the CFO of your own life. You have a certain amount of capital, that's your down payment, and a certain monthly cash flow, that's your housing budget. The real question is, what is the most efficient and prudent way to allocate that capital and manage your risk in this environment? From this perspective, renting isn't throwing money away. It's purchasing flexibility, mobility, and shelter while avoiding major risks. And buying a home isn't just getting a place to live, it's making a massive, leveraged investment in a single illiquid asset. Okay, so here's when each choice tends to win out financially. Renting is the clear victor when your monthly rent is significantly less than the true all-in cost of owning a comparable place. This is especially true if you think there are any life changes on the horizon, a new job, a new relationship that might cause you to move in the next, say, 5 to 8 years. Now the key, and this is the non-negotiable part, is that you must have the discipline to invest the monthly savings. On the other side, owning is still a dominant wealth-building tool if, and this is a big if, you have a long time horizon. You need a decade or more for your loan to pay down, for the property to appreciate, and just to overcome the huge costs of buying and selling. It works best when you can lock in a stable payment and avoid properties that are exposed to those exploding HOA and insurance costs. Your job is to honestly look at which of these two columns your life fits into right now.
And this is exactly why the debate is so intense right now. This headline from Axios, which reported on that lending tree data we just saw, it perfectly captures the current moment. The conditions we just listed in the renting wins column, especially that first one, that rent is less than the true ownership cost, well, that's not an outlier. It is the baseline condition in pretty much every major city in America. The monthly cash flow math is just undeniable at this moment in time.
But then you'll be scrolling online and see another headline from a different organization that claims, actually, owning is cheaper in a majority of U.S. counties. So, which is it? How can both of these possibly be true? Well, the answer is always in the fine print. They're measuring different things. That first report, the one from LendingTree, is comparing monthly costs in major, dense, and expensive metro areas. The second report is often looking at a much broader set of thousands of counties, which includes a lot of rural and suburban areas where home prices are way lower. And on top of that, they might be using different assumptions about the down payment, or, and this is the big one, they might not be fully accounting for all those stealth expenses. The lesson here is to never just trust a headline. You have to understand the assumptions behind the analysis before you can trust its conclusion.
So, how do you cut through the noise of national headlines and figure out the right answer for you, in your city, for your specific financial situation? Well, this next section is all about giving you the tools to do just that. We are going to build a comprehensive framework from the ground up so you can run your own numbers with absolute confidence and just ignore all those conflicting reports. The first and most vital concept you need to master is what I call the true monthly ownership cost, or TMO. Almost every online mortgage calculator you find is going to show you a number called PIT. That stands for principal, interest, taxes, and insurance. In today's market, relying on PIT alone is dangerously incomplete. It will mislead you into thinking a home is more affordable than it really is. TMO is the real, all-in number you need to be comparing against your local rent. So let's break TMO down, step by step.
Step 1, that's your basic mortgage principal and interest. Pretty straightforward. Step 2 is property taxes and homeowners insurance, the T&I and PITI. But now we get to the parts where this broken economy really sinks its teeth in. Step 3 is HOA fees, if they apply. Step 4 is the utilities delta. That's the extra you'll pay for water, trash, and electricity in a bigger house versus what might be included in your rent. And finally, Step 5, the one almost everybody forgets, setting aside money for maintenance and capital expenditures. This isn't for new paint, this is for the new roof you'll need in 10 years, the water heater that will fail in 7. A good rule of thumb is to budget 1% of the home's value each year for these reserves. On a $500,000 house, that's over $400 a month you need to be saving. These last 3 items are what can turn an affordable mortgage into an unaffordable home.
But the analysis doesn't stop with the monthly costs. On top of your TMO, you have to account for the enormous one-time costs of just buying and eventually selling a home. I call this the friction stack because these costs create this immense financial drag on your investment returns, making it really difficult to build equity quickly. Let's look at how these friction costs stack up. When you buy, you'll pay closing costs. That can be 2 to 5% of the purchase price. Then when you eventually sell, you're likely going to pay real estate agent commissions, which can be another 5 to 6%. Add in transfer taxes, the physical cost of moving, and the single most overlooked factor, the opportunity cost. That is the money your huge down payment could have been earning if you had just invested it in a simple stock market index fund instead. All told, this friction stack can easily eat up the first 10% of your home's value. And this is precisely why the length of time you plan to stay in the home is the single most important variable in this entire equation. So once you've calculated your true monthly ownership cost and you fully understand the impact of that friction stack, the final answer to the rent versus buy question for you personally really comes down to how you model 3 key variables. The entire financial outcome hinges on the assumptions you make about these 3 things. Let's break these down, because this is the real core of the calculation. First, your time horizon. The longer you plan to stay, the more years you have to pay down your mortgage and let the home appreciate, spreading out those huge friction costs until they're not a big deal. Second, the monthly spread. This is simply your TMO minus the rent on a comparable property. If that number is positive, meaning it costs you more to own each month, how much more is it? A $200 difference might be a worthwhile investment. A $2,000 difference is a massive financial hurdle that requires incredible home price appreciation just to break even. And that leads to number 3, the return spread. You have to make a realistic guess about how much your home will appreciate per year versus how much your down payment and monthly savings could grow if you invested them. If your monthly spread is big, you need to believe in some very strong, very consistent home appreciation to make buying the winning bet. Now, this framework is the absolute core of making a smart decision. And as we pivot to applying it, a quick reminder, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, we've defined the problem and we've built the framework. Now, let's actually put it to work. In this section, we're going to talk about how to apply these concepts to your personal situation with some actionable strategies, whether you're renting, looking to buy, or you're already a homeowner just trying to navigate these times. If you are currently renting and feeling frustrated, like you're falling behind, the single most important thing you can do is reframe your mindset. In a market where the monthly cash outflow to own is way higher than to rent, you are not failing. You are occupying a powerful strategic position. You have mobility, the ability to move across the country for a better job without getting hit with $50,000 in friction costs. You have optionality, the freedom to wait for rates to fall, for prices to soften, or for your income to go up. But this strategy only works if you are disciplined. You have to calculate the monthly spread, the difference between your rent and the TMO of a home you'd want, and you have to automate the investment of that savings every single month. That is how you win the game as a renter. Now, if you want or need to buy in this market, your objective has to be making a resilient purchase. This is not the time to stretch your budget to the absolute maximum the bank will lend you. You have to maintain a comfortable payment-to-income ratio so you have a buffer for the unexpected. You need to become a forensic accountant when you're looking at condos or homes in an HOA. Demand to see their financial statements, their reserve studies, the board meeting minutes. Look for any signs of financial distress. And please, please, treat that 1% maintenance budget as a real, non-negotiable line item in your monthly expenses. For older homes, you should probably budget 1.5 or even 2%. Build a fortress around your finances. And for those of you who are already homeowners in this broken economy, the name of the game is survivability. Your primary focus should be on strengthening your financial position to withstand the shocks of these rising costs.
That means aggressively rebuilding your cash reserves and your emergency funds. It means never, ever letting your homeowner's insurance renew automatically. You have to shop it with an independent agent every single year to fight back against those premium hikes. And just like a buyer, if you live in an HOA, you need to be an active, informed member. Go to the meetings, read the financials, and understand your community's fiscal health to protect yourself from the shock of a sudden, massive special assessment.
All right, finally, let's turn our gaze to the future. The housing market is not static. All those variables in our framework are constantly shifting. To stay informed and be ready to act when the time is right, you need to know which signals matter most. This isn't about trying to predict the future with a crystal ball. It's about understanding the present with a clear dashboard so you can react intelligently as the landscape evolves. Here are the key indicators to keep on your dashboard. On an ongoing basis, you've got to watch the Federal Reserve. Their decisions on interest rates will have the single biggest impact on your future mortgage costs. On a monthly basis, you need to zoom in from the national headlines to your specific local market. Track the inventory levels, the number of homes for sale, and the data on seller discounts. Is inventory rising? Are sellers getting more desperate? Those are the signs the market is shifting in your favor. And on an annual basis, keep an eye on the bigger, slower-moving trends in insurance costs and any new regulations that might impact HOA finances.
I want to end this section by really reinforcing a critical point. While the media and most buyers are completely obsessed with mortgage rates and home prices, the real sleeper issue that will define the cost of homeownership for the next decade is this toxic combination of runaway HOA fees and insurance premiums. These non-mortgage carrying costs are the ultimate wild card. They have the power to completely upend the math of owning a home, even if mortgage rates come down. Do not underestimate their impact.
So we end with this fundamental question. In this new economy, what role does a home play in your life? Is it primarily a shelter, a basic need providing stability? Is it an investment, a reliable vehicle for building long-term wealth? Or could it, if you make the wrong decision at the wrong time, potentially become a liability, a financial drain that just limits your freedom and opportunities? The honest answer is that it can be any of these, and the outcome depends entirely on the strategic decisions you make. The key takeaway from all of this is that empowerment comes from running your own numbers. It comes from making a rational choice based on the framework we've talked about, not an emotional one based on outdated slogans. You now have the tools to do just that. Thank you so much for watching. And one last time, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.